Hello everyone. Today we're going to have a brief market recap, then talk about the upcoming U.S. trade and wholesale inventory data, the weekly oil inventory figures, and Australia private sector credit growth. This is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you my daily market comment. Well, yesterday's fall in pending home sales in the U.S. forced a reassessment of the outlook. The figure was disappointing. It was down 2.5% month-on-month instead of being up 0.5% as expected. As a result, U.S. stocks and bond yields fell, and falling yields pushed the U.S. yields pushed the dollar generally lower. The yen was the main beneficiary, as falling U.S. yields narrowed the interest rate gap with Japan. Also, falling U.S. stock prices hit Japanese shares. And as you know, dollar-yen, not the yen, dollar-yen tends to move in line with Japanese stocks. Oil prices were lower after the American Petroleum Institute reportedly announced a 4.2 million barrel rise in inventories last week. The market was expecting the Department of Energy to report a 1.5 million barrel fall tonight in inventories. We've already had the first of the day's indicators out. The UK Nationwide Building Society's House Price Index beat expectations. It was up 0.8% month-on-month, much better than the expected 0.2% rise. Maybe that will finally spark some short covering in sterling. As for today, it's likely to be a quiet session in Europe, as there isn't much more data due out, or significant data due out during the morning. The action then will be concentrated around the opening of the U.S. market. The U.S. advance goods trade balance is expected to be little changed, so that probably won't be a major market mover. If anything, it could be negative for the dollar in that it's holding steady at a fairly wide level, as you can see. Wholesale inventories, on the other hand, are forecast to rise somewhat. That would be a welcome boost to growth after several months of destocking. It would probably be positive for the dollar. Subsequently, U.S. oil inventories, as I mentioned, are forecast to have fallen modestly in the latest week, as is normal this time of year. Note, though, that this forecast was made before last night's API data showed a rise in inventories. Now, if the official figures confirm the rise in inventories, it could disappoint the market further. Oil market participants are optimistic about OPEC cutbacks, bringing the markets more into balance. However, the U.S. rig count has been rising for many weeks now, suggesting that even if OPEC output falls, U.S. domestic output is likely to rise. So we could see the Brent-WI spread widen further if OPEC does cut back significantly while the U.S. expands production. Then overnight, Australia announces its private sector credit growth. Growth is expected to accelerate somewhat, which could prove positive for the Australian dollar, assuming that no news comes out of China to suggest further dampening of the economy there.